The American market seemed to be on hold with the Federal Reserve rate decision coming tomorrow. Let's go to Adam Turnquist, Chief Technical Strategist at LPL Financial. Thanks for joining us today.
Hey, good afternoon. Thanks for having me.
With most already expecting a rate cut, do you anticipate any kind of market rally on the news tomorrow?
Potentially, it's all about the messaging when we get the updated summary of economic projections. What are policymakers penciling in for the Fed funds rate next year? Also, what are their inflation forecasts? Consensus going into this meeting is for a hawkish rate cut, meaning the messaging might sound a little bit more hawkish and might not get as many rate cuts on the summary of economic projections as anticipated. The fixed income market has priced that in. We've had this big rebound in interest rates in the U.S. with the 10-year getting close to 415, 420, some important levels to watch. We'll see what happens and plays out tomorrow. The options market looking at maybe a little over 1% move on the news, but it's really going to be all about the messaging. I think the rate cut is priced in. It's just a matter of how dovish is Chair Powell going to sound tomorrow.
Yeah. What are you watching for in the remarks? What do you want to key into?
So when you look at the dot plot and the projections, how much consensus there is within that dot plot, where's the disagreements? I think it's going to be pretty scattered. When you look at the last few summary of economic projections, there's little consensus about how to manage interest rates. The other one is inflation. How is the Fed viewing some of the moves we've seen in commodity markets, tariff pass-throughs starting to show up in some of the goods components of inflation? How are they viewing that in the context of rate cuts in this softer labor market data that we continue to see?
Okay. Do you feel the markets are more influenced now by monetary decisions than they have been in the past?
I think so. When we look at just the day-to-day noise, we've had so many Fed speakers out with varying views, especially when there's a Fed chair position up for grabs for some of those officials. Certainly a major driver of performance. Fundamentals, of course, matter, but when you look at policy, and that's part of our outlook for 2026, it's just this policy engine, whether it's monetary policy or fiscal policy, they seem to be in the driver's seat right now, along with just momentum in the market, especially in 2025.
The markets, of course, have had a volatile year, the start of the Trump term, the reason for a big part of that. Do you anticipate that volatility to carry on into 2026 and for the same reason?
We think it will be a volatile year, above average volatility, we'll call it, for 2026. That's what history tells us. We have a midterm election here in the U.S. coming in November. Typically, the market does not like uncertainty. So that midterm election leaves the market with a lot of question marks about the composition of leadership in Washington. You typically have the most volatile year during midterm years out of that presidential cycle. We'll call it below average, but still positive types of returns. So we think that volatility will be present throughout 2026. The good news, though, for investors, volatility often brings opportunity as well for investors. We think maybe you'll get a chance to buy the dip in this bull market in sometime in 2026, maybe in the first quarter.
But you don't think necessarily that trade issues will continue to dominate?
Unfortunately, I don't think they're going away. Maybe they won't be as pronounced as we'll call the Liberation Day period, but I don't think they're going to go away. And I think that's going to be reflective in volatility, not just in equity markets, but that plays into the macro when you think about fixed income. Look what the U.S. dollar did this year, the worst first half since its inception in the 1970s. And you think about just the broader implications of trade uncertainty and how that can impact markets. We don't think that's going away in 2026. It's still going to be running in the background, maybe just not as noisy as this year.
Okay. Are you staying invested in AI big tech? Are you moving some of the money towards other parts of the build out?
We're constructive on the AI big tech theme. When you look at the CapEx cycle for this year and next year, estimates right now is that you're going to see just the hyperscalers, so the big companies building out those AI data centers, over $500 billion in spending. Those companies are spending about a quarter of their revenue now on CapEx. It's broad, it's global. We don't see that slowing down when you look at the trends, just the headlines, how many investments are going out around the globe in terms of AI. And they're holding up on margins as well. When you look at the returns on some of the margins, expectations, you look at Microsoft, for example, their gross margins still running at 67, 68% for 2026. Some of the other hyperscalers showing very good margins. So it will be a show me story, though. What's the quality of spending on that CapEx related to AI? What's the productivity gains that we're seeing? And of course, just the overall return on investment. I think that's going to be the big question mark in 2026.
I think that question has really sort of sucked out investor enthusiasm, right? Are you think investors are demanding too much too soon?
I think what investors are looking for is just consistency. What's the quality of the spending? And I think they've been a little bit surprised here by the reaction. If you flash back over the last couple of years, all it really took for the market to react positively was a big announcement on spending on AI. Now there's more scrutiny on that as these companies increase debt, and they basically load up their balance sheets with added debt. That brings volatility. And there's just more dispersion in performance within these names as well. If you look at the Magnificent Seven, for example, monthly returns are becoming more and more wide. I think there'll be bigger discrepancy as well next year when you look at the dispersion between the winners and losers on the AI spend.
All right, Adam, I'm going to leave it there, but appreciate your time. Adam Turnquist, Chief Technical Strategist, LPL Financial.